Welcome to Explain the Charts for our deep dive on March 16, 2026. Today we are looking at the USDCHF pair, which is currently at the center of a massive global financial storm. The primary driver right now is the escalating conflict in Iran, which has sent shockwaves through the energy markets. With WTI crude oil flirting with the $100 mark, inflation fears are suddenly back on the menu for the Federal Reserve. In the news, we are seeing the US dollar defy its temporary tops as it defends bullish multi-EMA support. The Swiss franc, typically a safe haven, is seeing mixed demand because high oil prices generally favor a hawkish Fed policy. Recent reports suggest the pair has been testing the 0.7900 level as the market weighs rate hike hopes against the risks of war. Financial analysts are describing the current technical signals as spooky, with some warning of panic starting to grip the stock market. Diverging paths between the Federal Reserve and the Swiss National Bank are creating a volatile environment for traders. While the SNB faces persistent deflationary pressures, the Fed is being pressured by sticky inflation and a strong labor market. Investors are desperately searching for new hedges as traditional wartime strategies are being disrupted by energy shocks. The Wall Street Journal Dollar Index has shown consistent upward momentum throughout early March, suggesting a broader strength in the greenback. However, many traders remain bearish, anticipating that technical zones on the daily chart could push dollar pairs downward. Today, we will determine if this is a temporary rebound or a structural reversal in the USDCHF trend. Let's jump into the data to see how these massive geopolitical events are translating into price action. Taking a bird's eye view on the daily chart, we can see a long-term struggle for the USDCHF pair. Back in late 2024, the pair was trading much higher, around the 0.88 to 0.90 range before a significant multi-month slide. By April 2025, we saw a major crash toward 0.8177, which at the time was a multi-year low. The downward pressure continued into early 2026, where the pair found a local bottom near 0.7630 on January 27th. Since that low, we have witnessed a persistent, albeit volatile, recovery phase. Looking at the candles from early March, there is a clear series of higher lows and higher highs forming. This recovery correlates almost perfectly with the rising tensions in the Middle East and the bounce in oil prices. The candle on March 13th was particularly aggressive, closing near 0.7910 with high volume. This move pushed the price above the 50-day simple moving average, which many traders were watching as a pivot point. However, we must note that the 200-day SMA still looms far above near 0.7926, acting as a potential long-term cap. The daily chart currently shows a spinning top formation, indicating a moment of indecision at these higher levels. Bulls need to maintain this momentum to convince the market that the 0.7600 floor is truly solid. Let's narrow our focus to the hourly chart from March 11th through the current session to see the breakout mechanics. On March 11th, the pair was struggling below 0.7780, but the U.S. inflation report provided the spark bulls needed. We saw a sharp climb through 0.7800 as Treasury yields began to spike in response to the CPI data. By March 12th, the price action became even more decisive, breaking through the 0.7850 resistance level. Each hourly dip during this period was met with aggressive buying, which is a hallmark of a strong trend. The RSI on the hourly timeframe turned bullish early on, signaling that momentum was shifting in favor of the dollar. Notice how the candles became larger and more frequent as we approached the 0.7900 handle on March 13th. The peak at 0.79168 was a clear rejection of the previous bearish sentiment found earlier in the year. This move was likely exacerbated by short sellers being forced to cover their positions as key levels broke. Geopolitical news about the Strait of Hormuz provided the fundamental fuel for this specific 48-hour rally. As oil prices hit their peak, the market priced in a more aggressive Federal Reserve, boosting USD demand. We can see a slight consolidation now as traders wait for the Fed's next move on March 18th. The current support on this hourly time frame is sitting firmly at 0.7850, which was previous resistance. If the price can stay above this zone, the bullish structure remains intact for the short term. A failure here would suggest the breakout was a fakeout driven by temporary news hype. Moving into the 15-minute time frame, we see the micro-level volatility that intraday traders are facing. The sessions on March 15th and 16th show the price oscillating between 0.7880 and 0.7905. The volume is slightly lower here, which is typical for the lead-up to a major economic release. We saw a brief dip to 0.7881 on March 15th at 21:17 Universal Time Coordinated, which was immediately bought back. This tells us there is still significant buy-the-dip appetite just below the current price. However, resistance near 0.7910 seems quite stubborn, as we've seen several failed attempts to break higher. This tight range suggests that a large move is brewing, likely to be triggered by the next headline from the Middle East. Traders should watch the 15-minute VWP to see which side is controlling the intraday momentum. Currently, the price is hugging the VWP, suggesting a neutral bias in the very short term. This is the perfect time to set alerts at 0.7915 and 0.7880 to catch the next directional move. Switching back to the 1-hour chart, let's look at the broader support and resistance landscape. Our primary resistance zone now starts at 0.7926, which matches the 200-day SMA we saw earlier. Beyond that, the psychological 0.8000 level is the ultimate goal for the bulls in the medium term. News reports indicate that if the conflict in Iran persists, the dollar index could push much higher. On the downside, we have immediate support at 0.7850 followed by a critical zone at 0.7800. If USDCHF falls below 0.7800, the bullish thesis for the month of March would likely be invalidated. The safe haven demand for the Swiss franc could explode if the conflict worsens beyond oil supply issues. In a true risk-off panic, the 0.7600 lows could be retested regardless of what the Fed does. Currently, 53% of traders are short, which often serves as a contrarian indicator for further upside. The high transactions during the March 13th rally suggest institutional participation in the move. Watch for any bull traps if the price spikes to 0.7950 and immediately reverses on low volume. The divergence between the S&P's 0% rate and the Fed's potential hike is a powerful carry trade driver. This interest rate differential is a major reason to be bullish on the pair as long as risk appetite holds. Short term, we are in a wait-and-see mode between these two clear price boundaries. The trend is currently up, but we are approaching overbought territory on some faster oscillators. To recap, the key price levels to watch are 0.7926 resistance and 0.7850 support. A clean break above 0.7930 would likely lead to a fast run toward the 0.8000 psychological level. I estimate a 60% likelihood of a test of 0.8000 by late March if oil remains above $95. Conversely, there is a 40% chance we see a retracement to 0.7750 if peace talks gain traction. Keep a close eye on the Federal Reserve interest rate decision coming up on March 18th. If the Fed holds rates but sounds hawkish, the USDCHF rally should continue with strength. Watch the daily candle close. If we finish the week above 0.7900, it reinforces the bullish bias. Be wary of geopolitical, black swan events that could favor the Swiss franc's safe haven status over the dollar. The RSI turning bullish on the 11th was our first clue, and the price action has followed through since. Deciding when to trade should depend on a breakout of the 0.7880 to 0.7915 intraday range. Always wait for a candle close above or below these levels to avoid being caught in a false move. Thank you for watching Explain the Charts, and remember to subscribe for more in-depth Forex analysis. Finally, please remember that this video is for educational purposes only and is not financial advice. Trading foreign exchange carries a high level of risk and may not be suitable for all investors. Please do your own thorough research and consult with a professional advisor before making any investment decisions.